Hello, and welcome to this tutorial on bond strips arbitrage. Strips are individual cash flows, that is, single cash flows due on one date, stripped from a bond and trading separately. Strips can also be thought of as traded discount factors since they're the price of a single cash flow. Arbitrage is a trade that offers a riskless profit with no net investment. Since such riskless profits are too good to last, in practice, arbitrage is the market mechanism by which prices of closely related instruments are kept aligned. So specifically here, bond strips arbitrage is how bond prices are kept aligned with their underlying discount factors represented by strips prices. Let's start with some definitions. What exactly are strips? So, as we said, they are the individual coupons and principal payments of a bond stripped from those bonds. In some government bond markets, individual cash flows may be stripped to create these strips that are traded. The market prices of these strips are essentially discount factors, as we just noted. Strips may be reconstituted to recreate the original bonds, and this is a very important fact. And that's what allows this arbitrage enforcing mechanism to work, to keep the pricing of the strips and the bonds aligned. So to understand this, let's look at an illustration. Suppose we have a bullet bond here represented by these three cash flows. So we got some coupon payments and then a final payment of principal and interest. We strip these so that each of these cash flows occurring in year 1, 2, and 3 are now traded as separate instruments. Strip 1, strip 2, strip 3. Now suppose the cost of the bond that hasn't been stripped trades at a price of 97, but the total cost of the strips that are trading in the market has a price of 98. So in this case, we'd say the bond is cheap relative to the strips. And there's an arbitrage available. And how would it be done? We buy the bond for $97. We strip it, and then we immediately sell it for $98. So we get an immediate $1 profit for no risk. Now, if we have the opposite situation where the cost of the bond is higher, $99, than the price of the strips at 98, we do the opposite trade to realize the arbitrage profit. So we'd buy the strips for $98, reconstitute the bond, and sell the bond for $99. And again, realize an arbitrage profit for $1. So whether the cost of the bond is higher or lower than the price of the strips or the total cost of the strips, there's an arbitrage available. So it's only in the case where the cost of the bond is exactly equal to the total cost of the strips that there will be no trade and no arbitrage possible. So let's consider a specific numeric example. Suppose we have a 3-year bond with a 10% annual coupon and it's trading at a price of $94.25. So these are the cash flows, $10, $10, and $110. And the price for that today is $94.25. Now let's suppose also that this bond has been stripped, so some of those strips are trading in the market at prices of 90, 80, and 70 respectively for the 3 years. So the question is there an arbitrage available? Is the bond trading fair relative to the strips or not? Well, let's see. We'll take the bond cash flows of 10, 10, and 110 that have been stripped. We'll see what the strips cost of each of those cash flows would be. So 10 times 0.9 is $9, 10 times 0.8 is $8, and 110 times 0.7 is $77. We sum that together for $94, and we see that actually the bond is rich. The bond goes for a price of $94.25, and the total cost of the strips is $94. So what's the trade? Well, we would buy what's cheap. So we'd buy the strips for a total cost of $94, reconstitute the bond, sell the bond for $94.25, and realize a 25-cent profit. So seeing the specific trade here, we buy each of these. And this is the total amount we would pay for a total of $94. And then we sell it. We reconstitute it and we sell it for $94.25 and realize a gain of 25 cents. So we would do this forever. And this is what drives the prices back into alignment. So in the case we just looked at, the bond is rich, and so reconstitution in that case is profitable. So we sell the bond and we buy the strips, and that's going to tend to drive up the price of the strips and drive down the price of the bond that we're selling. If the opposite were the case, if the bond were cheap, then stripping would be profitable. We'd buy the bond and sell the strips, driving up the price of the bond, driving down the price of the strips. So in either case, we're driving them back towards an equilibrium situation where the price of the bond equals the sum of the value of the strips. So there's some qualifications to this. First, bid-ask spread can affect the arbitrage. So in the previous examples, we've assumed that we could buy or sell at a single price, the same price, and that's rarely the case in reality. Typically, instruments trade in markets where market makers offer to sell at one price, the ask, and buy at a lower price. And so that's going to introduce friction. So obviously, if there's a bid-offer spread that's more than the difference in prices, then effectively, after taking account of the bid-offer spread and paying it, the arbitrage can disappear. There's another quirk that will interfere with this relationship, and that's in the real world strips markets. The principal remembers from which bond it came. So what do we mean by this? Essentially, what we're saying is when you're reconstituting the bond, you actually need the actual principal strip from the original bond, that will have a separate security serial number, and it has to be the principal strip of the reconstituted bond. So that means the principal strip from bond 1 will not be a substitute for the principal strip for bond 2, even if they are occurring on exactly the same day. And similarly, these principal strips are not substitute for coupon strips due on exactly the same date. So this means that these will not be fungible. So we could have 3 instruments trading in year 4 on a particular day. Coupon strip, a principal strip for a first bond, a principal strip for a second bond. They will not be fungible to one another, and therefore they could and sometimes do have different prices. Now, the coupons get where they came from. So what this means is once the coupons have been stripped, they're fungible with all other coupons from other bonds, so long as they fall on the same payment date. So when you're reconstituting bond, all you need is a coupon strip that can come from any bond with the aligned dates. And for that reason, the coupons strips for different bonds will always be the same. So to maximize the benefit of the stripping and maximize liquidity, it's important that the sponsor of the program, the government, that would be issuing the bonds and allowing them to be stripped, would align the coupon payment dates. And so what that would mean is, as there are several bonds, in this case we have 5 bonds, with coupon payments on the same date, these can all be fungible with one another, and therefore they can trade fungibly rather than as separate instruments, reducing the market efficiency. So finally, to understand really how this reconstitution works and what's legal and what's not legal, let's assume we're trying to reconstitute our 3-year 10% bond. And suppose that there's in the market trading coupon strips, principal strips from this bond, as well as principal strips from another bond. So we assume we have coupon strips from the 3-year 10% bond. There are other coupon strips from other bonds, another bond, let's say, that aligned with the same dates, but they came from a different bond. And then we have principal strips from the bond we're looking at, as well as another bond, again, aligned on the same date. So what's important to note is these cannot be mixed and matched arbitrarily. So what's legal? So case A is legal. So we've got a coupon strips from the original bond. They didn't need to be from the original bond, but they are. And importantly, the principal strip comes from the original bond, the 3-year 10% bond. So A is legal. What about 2? Well, here the difference is the coupon strips came from another bond, from bond 2. But that's okay, because coupon strips are fungible across bonds. And the principal strip came from the original bond, so that's legal as well. What about case C? In this case, the coupons came from the original bond, which is okay, but the principal strip came from another bond. It didn't come from this bond. So this one is not legal. What about D? Here, all of the strips are coupon strips. Well, that again is not legal because we need the principal strip from the original bond. So that's not legal. And then finally, what about this one? Suppose we do have the principal strip from the original bond, but we use that also for the third-year coupon payment. Well, that's also not allowed, so that's illegal. The coupon strips can be from any bond, but they must be coupon strips. The principal strips must be the principal strip from the bond that you're reconstituting. So hopefully that clears that up. So that's it. Let's just summarize some conclusions about the strips market and how bond strips arbitrage works. So government bonds will set up strips programs, and this enables the direct observation of discount factors across the full curve because each of these strips will essentially represent the discount factor. The strips program adds values for investors because it enables them to buy the exact cash flows they may need for some purpose. It could be hedging, or it could be some other kind of matching that they're trying to do. A strips program with both stripping and reconstitution, and the reconstitution is important, improves liquidity and pricing efficiency via arbitrage because it keeps the bond pricing aligned with the pricing of the underlying strips or discount factors. And the efficient price discovery is facilitated by making this as liquid as possible, and that's done by aligning the payment dates, and so that the coupons from many bonds will be fungible, and that will increase the amounts falling due on a single date. Finally, the arbitrage will cause the observed discount factors to be fairly price efficient, but we observe there's modest variation due to the non-fungibility between principal and coupon strips, and of course between principal strips of different bonds, and also the bid-ask spread. So that's it. Thank you for listening.